Good evening, good afternoon, good morning, wherever you're watching or listening to us from. You're welcome to Stock Team, the Investors Channel, today, the 26th of February 2025. Before we go ahead, let's just make a usual disclaimer. Every information shared on this channel is for information and education purpose only. So do your due diligence or consult your financial advisor before making any decision. And on that note, we welcome everyone to today's episode. Thank you for subscribing. Thank you for joining this channel. Please also follow us on X, our X community at Stocker Team Live, where we bring you all the breaking news that moves the market and, of course, your portfolio. Today, I will be talking about the mega cap stocks that are quite cheap at the moment. And when I mean cheap mega cap stocks, I don't necessarily mean that in the average price that they trade at, that they are cheap. Actually, that's not how to look at a stock as an investor. You don't necessarily see the price of a stock, maybe it's trading at $300 or $500 or $250, and you think it's very expensive. Actually, there is a science behind what you're actually seeing. So even when you are paying more for an average price of a stock, there are so many other things or numbers behind that number that you actually have to look at before you actually conclude that this stock is expensive or cheap. Some stock might be trading at $10, $15, but they are quite expensive. And I will bring you to the real crux of why you shouldn't be looking at a stock based on the average price that it's trading at to determine whether it's expensive or not. As an investor, what you actually look at is what we call PE ratio, which is basically what you actually pay for future earnings of a stock. So the higher the number, the more expensive a stock is. But you also have to look at what the stock and other stock are trading at in terms of their PE ratio. So if a company is in the financial services sector or the tech sector or the information communication and technology sector, you have to look at the peers or direct competitors to the stock. What is the PE ratio that they are trading at? Is it high or low? Some stock will actually have a high PE ratio, and these stocks might actually be the best to own, while some will have a very low PE ratio, but they might not necessarily be a stock to own. So a stock can actually be expensive for a reason or cheap for a reason. Some are just expensive and there's no logic to it. So you also have to be very careful when you are trading or buying a stock based on the PE ratio. The PE ratio actually gives you the real number behind the number. If a stock is overvalued, undervalued, or moderately valued. So today, I am looking at 3 to 4 mega cap stocks that are actually very cheap, and they are cheap for a reason at the moment, because in the last couple of days or weeks, some of these stocks, they've gotten a huge beating, and that's actually the best time for you to invest. So come with me. Please just join me as I bring you the first stock. So the first mega cap stock I'll be looking at that is quite cheap at the moment, vis-a-vis is peers in the Magnificent Seven, is actually Apple. So yes, Apple might actually look, on the average price that you can see on the chart, might actually look, oh, it's expensive, it's $240 per share. So if I have to buy 10 units or 20 units, I have to fork out thousands of dollars or thousands of pounds or euro, depending on what currency, or even millions of dollars of naira, depending on what currency you are actually investing with. However, Apple is still quite cheap compared to some other stocks, even quite cheap compared to what you even have for Palantir. But we're not talking about Palantir today. We're talking about the mega cap stocks. At the moment, the PE ratio for Apple is actually 28.5. And the most expensive stock within the Magnificent Seven, which is Amazon, is trading at about 65.4. So to an extent, even when Apple more or less has a bit, underperformed in a couple of years ago or less than 2 years ago, Apple is still quite cheap compared to the revenue they actually record, the kind of scale of the business of Apple, the innovation that Apple might actually bring on board in the next couple of years. And let me actually show you why I think Apple is actually still very cheap at this price. So if you look at the last 1 year, Apple actually, just did about 32%. 32% is quite very, very huge for a company, valued over $3 trillion. However, if you look at what Apple has done in the last, 6 months, even year to date, Apple seems to have taken a lot of beating, and year to date, Apple is now actually negative, down by about 3 to 4%. So between you and I, 3 days ago or 2 days ago, Apple announced that it will be investing close to about $500 billion in its AI servers and some other manufacturing plants in the US, and the company will be, employing over 20,000 people. So, from what Apple actually said, Apple has said just a few things, but they've said so much, especially when you can read meaning to what Apple is actually doing as a company. Yes, the Apple car that was rumored for so many years has been laid to rest, but it seems that the future of Apple is actually Apple Intelligence. Apple is likely to come up with some newer devices that is not just an iPhone. Apple is likely to unify the Apple ecosystem. So for me, at 28.5 PE ratio, Apple is a buy. At least for the next 1 year, Apple is a buy. The next stock I'll be going to is actually Alphabet, or Google. Alphabet is the parent company of Google. Now, this is actually the cheapest stock in the Magnificent Seven, or even the cheapest mega cap stock. At the moment, Alphabet trades at about 20.5 PE ratio, which means actually you are paying very, very, very little for actually owning a unit of Alphabet stock. Yes, the stock, if I go down the memory lane, all time is done over 514%, and this doesn't actually take into cognizance the stock splits. Actually Alphabet must have done over 100,000 percent return, but just looking at the stock splits that have been done, this stock has actually run so high for so many years. But if you look at the last 1 year, Alphabet actually struggled to do about 24%. If you look at the year to date, this stock is now down by about almost 10%. What does that mean? Is that if Alphabet should actually get its act together in the next couple of days, I won't say this per se, in the next couple of months, at least the next 6 months, this stock might actually reclaim the entire loss for the year and set for actually a bullish run, because the AI race, monetizing the AI, it is still the big mega cap stocks, it is still the big tech giants like Apple and Alphabet that will actually squeeze out the dollars from the pocket of either the enterprise or the average consumer on the street. Now, the next stock I'll be looking at is Microsoft. Microsoft seems to have actually gotten its own beating, but on a PE ratio basis, looking at whether this stock is expensive or not, Microsoft seems to be a bit fairly valued, but year to date, the stock has also lost about 6% of its value. And in the last 1 year, Microsoft has been bearish, not moving so high, but it's actually lost about 2%. So with a P ratio of about 30.1, I actually believe this stock is now has gotten to that capitulation stage, and in the next couple of months, when Microsoft actually cracks the consumer market as to how it wants to monetize AI, when Microsoft relaunches Microsoft Copilot for the enterprise, I believe this stock will actually do better this year. At least this stock should return about 15% by the end of this year, all things being equal. The last stock I'm going to look at, which I've spoken about, is actually Amazon. And one thing about Amazon is that this company reports almost the second largest revenue in the entire world, and that's just behind Walmart. Year to date, Amazon has lost about 3.6 to about 4%. In the last 1 year, this stock also didn't do so exceptionally well, but 22% isn't small for a company valued at over 1 trillion, or even not more, if not more than that. So with about 65 PE ratio, 65.4 PE ratio, actually, Microsoft, Amazon rather, is the second most expensive behind Nvidia. But I still believe if by 2028 Amazon is able to actually record an annual revenue of about 1 trillion, which might actually make them overtake Walmart in terms of the biggest company, the company with the biggest revenue. This company is actually likely to double its valuation. And if you are looking for a 3 to 4 years, runway to actually own a very good stock, Amazon is actually the stock to own. So that's it for today. I've spoken about you actually deciding to buy a stock, not just because the average price, quote and unquote, seems expensive to you, but you actually have to look at the P ratio. P ratio tells you much more story. Like I said, a stock can actually have a lower P ratio and it's not a good stock to own. Another stock might have a higher P ratio. It's actually better to own that. Some stock will actually have a lower P ratio, and it might actually mean that at the moment that stock is undervalued, and it might actually be the best time to actually have your position or build it when that stock is still underperforming. So that's it for today. So if you see a stock, a stock like Apple, a stock like Alphabet trading at over 100 and something dollars, that doesn't necessarily mean it's expensive. Amazon now trades at about $213 as we speak, but that doesn't necessarily mean it's expensive. The P ratio tells you the much more story. Sometimes if a company or a stock has a higher P ratio, it might actually mean that investors and shareholders are willing to pay more to own that stock because they believe it's actually going to outperform the peers, or do better in terms of return. So thank you so much for watching. Please subscribe to our channel, put on your notification bell so that you don't miss tomorrow's update. Yes, tomorrow will be coming to you. Also join our community on X at Stockerteam Live. We would like to actually share with you all the breaking news that moves the market and of course your portfolio. Thank you so much. Till tomorrow, keep investing, keep growing. Thank you. Take care and bye bye.